Review of Accounting, Introduction to Analysis, Chapter 2, Lecture 4. Analysis of the overall statements that we're looking at is how are increases in current assets being financed? Is there an associated buildup in current liabilities? How are increases in long-term assets being financed? And preferably, adequate long-term financing and profits should exist to finance long-term assets. And short-term funds may be used to carry long-term needs. Could be a potential high-risk situation as short-term sources of funds may dry up while long-term needs continue to demand funding. The question is, what does all of that mean? And we'll get into the analysis of being able to understand the cash flow statement not only, but understanding different ways to analyze financial statements to come with better results for us as financial managers. Earnings per share. It's a good thing to remember, possibly for your homework, is net income minus dividends on preferred stock divided by average outstanding shares. So there's the formula for you for earnings per share to be able to understand how to calculate. Earnings per share example is company ABC has net income of $1 million. Dividends on preferred stock is $100,000. The average outstanding shares is $1 million. Take $1 million minus $100,000, which is $900,000, divided by $1 million, and you get 90 cents earnings per share. PE ratio is also something valuable to learn, possibly for your homework. It's the market value per share or divided by earnings per share. Market value per share is the current stock price that it might be at that day. Price earnings PE ratio is a multiplier applied to earnings per share to determine the current value of common stock. It indicates expectations about the future of a company. Some factors that influence PE are earnings and sales growth, risk, which is a volatility in performance, the debt to equity structure of the firm, dividend payment policy, or quality of management. It allows for comparison of the relative market value of many companies. Firms with higher expected returns will have higher PE ratios typically, and price earnings ratios can also be somewhat confusing. A drop in earnings may not match the magnitude of the fall off in earnings, which causes increase in PE ratios. So the PE ratio could be higher, but it doesn't necessarily guarantee a greater return because of this. The expectation of returns and PE ratios do change over time as well. So you can see here are some PE ratios for some specific companies over time. As you can see, Cisco from 1990 through 2001, its PE ratio is 91 in 2001, but as you can see, its PE ratio dropped off in January of 2006 and 2010. So it does not necessarily mean that the company is continuing to outperform the market with its PE ratio. Depreciation and funds flow. Depreciation is a non-cash expense. It's not a new source of funds, and is added back to net income to determine the amount of actual funds on hand, and it attempts to allocate the initial cost of an asset over its useful life. Its charging of depreciation does not directly influence the movement of funds itself. It's almost this imaginary thing that we're devaluing the asset that we might have, but in writing that. And here's a comparison of accounting and cash flows. The other thing to keep in mind for your homework is understanding free cash flow. It's cash flow from operating activities minus capital expenditures minus dividends. Capital expenditures is maintain productivity capacity of a firm, and dividends maintain necessary payout on common stock and to cover any preferred stock obligations as well. Free cash flow is used for special financing activities. Example would be a leveraged buyout. Good to know this formula as it will come up throughout the semester. Some income tax considerations as well as the corporate tax rates. The top rate is about 40%, including state and foreign taxes, and the lower tax bracket for corporate tax rates is somewhere between 15 and 20%. The cost of a tax-deductible expense minus interest, travel expenditures, salaries, etc. And here's just an example of what taxes can do to your earnings. If you have EBIT and then you have some interest that you had to pay out versus Corporation B that did not, I mean, you can see a vast difference in earnings and tax rate because of that. Depreciation can use as a tax field as well, but even though it's not a new source of fund. Some of the tax shield advantages you can see here is that since depreciation is added in here for Corporation A, it actually decreases their tax burden and in turn increasing their overall profitability as a firm. That is ended Chapter 2, Lecture 4. Please see on-course resources for Chapter 3, Lecture 1 once we get into full ratio analysis.